Test one, two. Test one, two. Hey, everyone. Joseph Kelly here, committee chair. I'm going to call the meeting of the Credit and Risk Mitigation Committee to order. Item number 2, Linda.
We can do the minutes as soon as we'll do it at the end.
Procedure for teleconference.
We don't have any minutes.
Okay, fine. Approval of the minutes. We're waiting on one committee member who will arrive very shortly, so I'll move that till after the committee report. Any public comment?
We don't have any requests.
Thank you very much. Mr. Mazregian, over to you, sir, and your colleagues for a report on the private credit overview.
Bache, I'm just going to do a roll call real quickly.
Oh, sorry.
It's okay. Thank you, Mr. Kelly. This meeting is being conducted as a virtual meeting and in person. So I will do a roll call of the trustees to confirm attendance. 1 second. Okay. Mr. Kelly,
Present.
Mr. Jones,
Present.
Mr.
Oh, I'm sorry. Mr. Jones, yes, present. I didn't want to jump Onyx there just in case.
Oh, Mr. Jones, are you in the meeting?
Yes.
Okay. Thank you. Mr. Jason Green, Mr. Rue, Mr. David Green.
Good morning.
Thank you. Mr. Knox.
Good morning.
Thank you. Mr. Jones, Mrs. Jones. Morning. Ms. Sanchez. Good morning. And Mr. Santos. Okay. Staff participating in the meeting include the following: CIO John Grable, CEO Santos Kryman, Chief Counsel Stephen Wright, investment staff Bache Masaragian. And we also have James Walsh and Kristen Jones from Alborn and Tim Filler from the Makita Group. Trustees, please use the raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Thank you very much, Linda. Mr. Mazregian, over to you.
Thank you. Good morning, Mr. Chairman, committee members, and trustees. I'm pleased to introduce our guest speaker, Kristen Jones. Kristen is a partner at Alborn, and she's going to provide an overview of private credit, which, as you know, is a very broad market. Kristen is the head of U.S. private credit at Alborn and a senior private markets research analyst who specializes in investment due diligence. So she's an expert on the strategies and managers in the private credit universe. Now, as a reminder, LACERA's most recent strategic asset allocation, the one approved by the board in 2021, set a target allocation of 11% to the credit functional asset category. And that 11% allocation is further divided into 4% to liquid credit and 7% to illiquid credit. The strategies Ms. Jones will describe are part of the illiquid credit allocation. Now, before I turn it over to Kristen, I should introduce Stephen Kennedy to her left, who is one of the primary consultant contacts to LACERA from Alborn.
Thank you, Bache. Before you hand over, can I just ask a question? Is it all of the 7%? You say this is a portion of some category. Is it all of the category, or what relative percentage is it of the category?
As you will hear from Kristen, illiquid credit and private credit are interchangeable terms, so you can think of it as all.
Okay. Yeah. Thank you very much. Good morning.
Good morning. Thank you for the introduction, Bache. Thanks for the opportunity to be here today. So it is that 7 of the 11% allocated to illiquid credit that brings us to the conversation we'll have for the next 30 minutes or so, where we'll take a deeper dive into the illiquid credit markets and what all that means. So even just on the point of that, after spending any amount of time looking at this space, you'll immediately notice that many different terms get used. You'll hear direct lending, sponsor lending, non-bank finance, private credit, private lending, the alternative lending, the list really goes on and on. So I'm here today to help sort of demystify some of that terminology that gets used and also provide a broader overview of the illiquid or private credit space, the size of the markets, the types of sub-strategies that can be used, risk and return expectations, and some considerations for the roles that credit can play in a portfolio across cycles. Since I've already used the term liquid credit and private credit interchangeably, I think it's a good place to start. So in general, private loans do not trade freely, and therefore they include an illiquidity premium. Hence the umbrella terms illiquid credit or private credit that really get used as a bit of a catch-all in the space.
Excuse me, Kristen. John, could you advance the slide, please?
Thank you, Bache. Are we up? Perfect. So in reality, there are many potential expressions of private credit with different nuances in the ways that they are pursued. Think position in the capital structure, that's referring to both seniority and security, the profile of the borrower, so the size and the health and the quality of the borrower, the types of collateral reference, so whether the loan is asset-backed or cash flow based, the use of the capital could be more offensive or defensive in nature. Many interesting nuances, which we'll go on to in the coming slides. But what I really want to highlight here on slide 2 is that across the wide array of strategies we see in private credit, the asset class has really risen in popularity for some common benefits that it affords borrowers, including the ones you see here at the bottom of the slide, namely flexibility, speed, certainty of close, creativity, confidentiality, above what banks and the public capital markets can offer. Next slide. So it's in large part for those reasons that we've seen the dramatic rise of private credit as an asset class post GFC. So in addition to those inherent attributes, there are some other dynamics at play that have really fueled demand. Think bank retrenchment post GFC, that's largely regulatory driven, volatile capital markets that can be either closed or selectively open at times, as well as the dramatic growth in the private equity asset class, which is really what produces the feedstock for most direct lenders. So you can see in the chart at the bottom here, the continuation recently of that trend away from the syndicated markets and towards financing is being done in the private credit markets. You can see it directly in the relative size of that dark green bar, which represents private credit. It's far exceeding the liquid and broadly syndicated market loan proportion of LBO deals. Notably, that includes larger companies and larger financings. So historically, those that would have been done in the liquid markets, nowadays it's not uncommon to see billion-dollar plus private transactions. An extension of this trend, also worth mentioning, is the rise of unitranche transactions in recent years. So these are hybrid loan structures that combine both a senior and a subordinated debt component into one loan with a single credit agreement. So in addition to being quite appealing for just the simplicity of a unitranche financing, they're often larger. So that means providing a level of financing that would otherwise be difficult to get from a bank. There are also some other broader market and cycle dynamics at play that have really propelled the growth of private credit. A search for yield over a decade of ultra low interest rates, investors' affinity for more stable returns, all combined, that's really driven elevated investor allocations to the space. And that's across most investor types and across most geographies. So it's the size, the scope, the reach of private credit, from really the most vanilla direct lending to the most sort of niche capital gaps that have essentially meant there's something for everybody in the asset class. All told, private credit AUM has now surpassed an estimated 1.2 trillion. So that's approaching 1/3 of the total credit market, which, by the way, has tripled since the GFC. So from essentially zero in 2008, private credit markets have grown to be roughly the same size as the US high yield and leveraged loan markets of the GFC era. Next slide, please. Okay, so private credit markets are big. They've gotten bigger, and they have some real benefits that they bring to the table. Let's talk for a few minutes now about the different strategies and profiles that can be pursued in private credit. Getting to your question, Joseph, of what all are we talking about here? As you'd expect, the risk and return profile can be dialed up or down in a number of different ways. At the lowest end of the risk return spectrum, target returns have historically reached as low as 5% or so, before other sources of capital, typically those with a lower cost of capital, step in as a capital provider. At the highest end of the risk return spectrum, you have strategies that are quasi-equity-like, such as distress for control. Those are targeting commensurately high returns, call it 20% plus, hence that quite wide range. Along this same continuum, you also have a mix of return drivers. So at the simplest level, some combination of contractual income and or appreciation. The more lending-like, the more returns are driven by contractual income, really clipping a coupon. In terms of structure, commingled closed-end fund structures are still the most common vehicle. However, many managers have expanded their offering types to include evergreen offerings, levered and unlevered options, BDCs, insurance-friendly structures, separately managed accounts, funds of one, and increasingly via retail products as the democratization of private credit trend really continues. So just turning briefly to the verticals on the bottom here, Allborn's outlines its private credit mandate into 6 different verticals. Sorry, I lost my presentation. I'm so sorry. I'm just going to grab I have a paper backup. Okay. That's okay. We'll keep going with this. So the 6 main verticals here are based on the key risk and return drivers. So within each vertical, there are a range of sub-strategies that get pursued, each with sort of further distinctive characteristics. Think differences in approach to sourcing, structuring, use of leverage, exit strategies, the drivers of the opportunity set, competitive dynamics, et cetera. The point really being that there are numerous ways that you can play private credit. It's a very dynamic market and the relative value is constantly changing. So partnering with best-in-class managers, well-aligned managers to pursue strategic and/or tactical goals is a really thoughtful way to build an illiquid credit portfolio. Next slide, please. So as I was mentioning, the risk return spectrum can be dialed up or down in a number of different ways. This graphic is really included to provide some general context for where the main private credit strategies fall on this risk return spectrum relative to one another, but also relative to IG, leveraged loans, and high yield bonds on the lower left end, and then also relative to private equity at the higher risk, higher return end of the spectrum. In reality, of course, these don't fall in a perfectly linear relationship like we see here. And there's dispersion within each, which can be narrower or wider. But I find this type of framework is really helpful for having conversations around portfolio fit and realistic expectations from private credit. Next slide, please. So just picking up a bit more on that idea of portfolio fit and the realistic expectations one can have. On the left, we have some key credit attributes that help define the exposures being taken. And then on the right, we have some key portfolio fit attributions that come up when allocating to private credit. So just starting on the left, seniority really refers to where the debt instrument ranks in order of repayment. So private credit can be senior or junior, but it typically sits above preferred and common equity. Security refers to whether the loan is backed by collateral or not. So most private credit requires collateral. In other words, they're typically secured loans. Leverage refers to asset level leverage and also fund level leverage. Some strategies like direct lending can be offered in levered or unlevered formats. Others are highly reliant on leverage, including most forms of real estate lending, specialty finance, and others tend to use little to no leverage, think distressed. Resilience refers to the likelihood of permanent principal impairment. By virtue of the 3 traits above, plus some other structuring bells and whistles, sourcing and selection, tools for working out troubled situations, private lending can really offer attractive returns with less downside risk and less volatility compared to comparable liquid credit. So again, the right, these are portfolio fit attributes to keep in mind. Income generation primarily refers to the yield that accompanies fixed and floating rate investments. Most private credit is floating rate. For LACERA, one of the primary roles of the illiquid credit portfolio is current income. Return enhancement, whether through appreciation or upside optionality, or simply offering more yield per unit of leverage, Private credit can, in some strategies, offer upside potential as well. It warrants mention that LACERA's hard hurdle fee structure is set up to only pay for performance fees above expectation returns. Diversification refers to the fact that private credit performance can demonstrate low correlation with other asset classes and the business cycle in general. LACERA's allocation to illiquid credit is in part specifically in appreciation of this diversification away from growth-driven strategies in particular. Fees and liquidity are included as a reminder that lower fees can be alpha in credit. LACERA is seeking to benefit from its scale to get better fees and better terms. And in terms of liquidity, again, private credit is by definition a less liquid asset class, so you should be compensated with an illiquidity premium. Notably, LACERA's preference for evergreen mandates ensures that you're not forced sellers, which could be quite painful in this illiquid asset class otherwise. Next slide, please. So here we see the median private credit return performance post GFC and pre the current era of rate and spread widening. Again, the asset class was really born out of the GFC and gained momentum starting around 2010. In the 10 years that followed, performance has consistently been in the 6 to 11% range. Dispersion has been quite tight in private lending, but generally widened out the further the return and appreciation spectrum you went. Today, as markets progress through the cycle and as volatility increases, dispersion in lending is expected to increase. So I've mentioned a few times, private credit has consistently offered an illiquidity premium over the broadly syndicated loan market. This premium does fluctuate with markets ranging from, call it 0 to 300 basis points, and typically falling somewhere in the middle of that range. How that contributes to the overall return profile can be seen in the illustrative return breakdown on the bottom right of this slide. So private lending investments, again, are typically floating rate, with interest rates quoted as a spread above a reference rate, such as LIBOR or now SOFR. You can see this here in the risk-free rate and the credit premium bars. Over and above the risk-free rate and the credit premium are the illiquidity premium and potentially a complexity premium. So those two bars on the far right. Think of the complexity premium as really a return pickup to compensate for any deal complexity. Transacting in a dislocated sector, an out of favor business approach, really compensation for anything that adds uncertainty or complexity. Given the increase in base rates, the increase in spreads, the increase in complexity, current underwritten gross asset yields have increased. It's really quite an interesting time to be a lender. Next slide. Thank you. This slide is included to provide some further context for where markets are currently. Yields are at or near the highest levels we've seen since the inception of the asset class, except for two periods, the GFC and the depths of COVID in March and April of 2020, when we saw spreads and all-in yields blow out. On the top chart, you can see yields of newly issued loans compared to similarly rated BBB syndicated loans. I draw your attention to the increase in yields that started mid last year, as well as that consistent premium. So the light green line on top of the dark green line. On the bottom chart there, you see the dramatic change in base rates we've gone through. From an ultra low rate environment where base rate floors of 1% were mostly in place, to base SOFR rates in the 4.5% to nearly 5% range today. We've also seen original issue discounts increase from 1 point to 2 or 3 points for all-in yields comfortably into the double digits. However, from the perspective of the borrowers, as opposed to the lenders, the increase in rates and spreads has dramatically increased their interest burden. For many, their debt service has effectively doubled. So that's challenging for most and unsustainable for some. Next slide, please. Thank you. So that brings us to default rates. COVID was a test of private lending, but it really wasn't the test for the asset class to see how it will perform through a broader business or credit cycle. The Fed's unprecedented intervention and the rapid recovery that ensued really distorted markets. Nevertheless, it did serve to highlight the flexibility that private credit has to manage their portfolios. This is illustrated through an implied annual loss rate for middle market direct lending that remains below 1% and below that of the broadly syndicated loan markets. Looking forward, we do expect default rates to increase, though not to the levels reached in the GFC. And we'd also suggest that understanding the health of the underlying portfolio is equally, if not more important than understanding the headline default rates and the headline loss figures, which are backwards looking and also really don't capture the nuances of the underlying credit exposures.
I have a question there.
Yes.
So right now we have kind of a 2-to-1 downgrade to upgrade rate in terms of credit revisions.
Yes.
And it would strike me that I'm not entirely certain that COVID was necessarily the litmus test you're describing. So I guess walk me through the fundamentals a little better. And also there is also a big bifurcation between investment grade credit and high yield credit, where we're really seeing the downgrade activity rolling pretty strong. And so just kind of walk me through your reasoning for that statement.
Sure. No, I agree. It was a test, but not the test. So I think it's a great question. COVID was a pressure test that really hit the revenue side of businesses quite dramatically. What private lending, the resilience of private lending really comes from the seniority, the structuring that they are able to write into private loan documents. I think maybe one of the points that does come through, a criticism that does come through, is in the valuations component. I mentioned allocators enjoying the stable returns of private credit. There are unrealized losses in these books. However, it's really the tools that the private lenders have that afford them some other opportunities to resolve issues before they hit a true principal impairment. So it's access to collateral, it's better access to management, it's call protection, it's the fact that most of this is not picking, it's actual contractual income. We will see default rates go up. We will, I presume, see losses go up slightly. However, relative to liquid credit, we do expect it to remain resilient. What we're focused on currently in understanding who has a more resilient portfolio, it does come down to better sourcing, better selection, and better structuring. So the lenders who really rode the wave of rising tides lifting all boats and not doing real fundamental credit analysis and not structuring their loans to have covenants that are early signals that don't get them a seat at the table to provide additional possibly runway if the company needs it, but also collecting amendment fees and enforcing creditor rights. We're keen on delineating between those who were merely on the bandwagon and those who truly have a more enduring role to play.
Yeah, and it's not unusual for us to go into a cov light structure right before sort of things go crazy.
Yes.
What do you anticipate is going to happen with regard to the distress for control kind of cycle that could play out over the next 5 years?
Yeah, no, it's a really interesting question. From the time I started in the asset class 15 years ago, when distress for control was really a standalone strategy and we saw funds pursuing that exclusively, I really view distress for control as a tool in a toolkit now, and increasingly part of a multi-strategy approach. You can enter, typically distress for control is entering through a public, well, there's a couple ways to do it, but entering with the expectation to end up in an equity position. There's a lot more intercreditor fighting this time around is one component. So I think there will be more pain and more risk for those who are not particularly large and who aren't incredibly diligent on the actual documentation piece. I do expect restructurings to come back as an opportunity, but one other trend that has really come through in the last handful of years is some form of almost more special situations solving outside of a formal process. So it's entering into the capital structure to have a seat and then providing a private solution that avoids going through a full formal in or out of court restructuring. So I think some of it will be solved outside of what we maybe would have called a traditional distress for control or restructuring process. But there will be pain. There are business models that don't work. There are capital structures that are over levered. That opportunity set should come back. Again, the key is picking the managers who have the right selection capabilities, the right fundamental credit analysis, and also probably the right workout desks. We have seen quite a few private lenders quietly building workout groups, signaling there's more credit work that's being done behind the scenes than they really had to do over the last decade. Yeah. Which really ties back into sort of what I was going through here, saying that it's really digging into the nuances of the underlying credit exposure that you need to do in private credit. So it's things like monitoring amendments and extensions, coverage ratios, pricing power, the profile of the equity and lender base to get a sense for what the risk of that intercreditor fighting might look like. These are really critical to truly understanding the risk profile of an illiquid credit book. Just on the second bullet point here, appreciating the known and unknown risks that are in the market. We are seeing credit managers taking a more conservative posture, including higher equity cushions, lower leverage multiples, and tighter loan docs when they can get it, really to position themselves for a recession or at least more challenging days ahead. It is an asset class that generally has less upside convexity. So it is managing recovery and loss rates that's really key to hitting those target risk adjusted returns, which I think ties in really well with Gina's questions. Next. Oh, please.
How do you measure or assess that risk for infighting amongst creditors potentially?
It's a really good, as part of the art of investing in credit, I would say. It's understanding the lender base, both in terms of who, the complexion, the split of tranche ownership, as well as really a style of the manager. There are certain managers who are more or less aggressive and who get a reputation for being more likely based on past experience to pursue such an approach. It also has to do with the makeup of the business, the underlying collateral. Are there opportunities to strip IP? Are there opportunities to carve off subsidiaries? So there are some situations that have more complexity to them, which could mean more opportunity for creditor infighting and asset stripping. So combination of who are the creditors, what is the makeup of the capital structure, but then also sort of the business and the assets themselves. And when the stars align in a certain way, that does happen. And it's something that can be an opportunity, but also a risk, depending on what side of the table you're on.
Thank you. I had two questions. The first is, what is the average loan size?
Average loan size varies. So everything from 2 million to 5 billion.
Okay.
Average loan size for a middle market loan is average EBITDA is around 50 million. Average loan size is, call it 20.
Okay. And then second question is, so you talked earlier on about this market developing over the last 10 years or so to become 30% of total lending market, total credit market. But if you think about that, that's pretty significant from the fact that this is a non-regulated market. we've stepped in, or other lenders have stepped in because the banks couldn't. And then you think about the regulatory framework that has been built around banks and their practices over the last 80 years. So my question is, where do you see the regulatory framework for private lending going? And what would need to happen for the market to become more regulated than it is?
Fascinating question. Regulation tends to come in when the consumer gets involved. And to date, this has largely been an institutional asset class. But I'd go back to the point I made about the democratization of private credit. The more we see this come into the retail market, I think that's the avenue where we could see more regulation come in. There's a lot of talk of what it could be. There's nothing imminent at the moment. So I think the more that trend accelerates and we see consumers holding these private loans through different structures, we've seen a little bit in the BDC market, that will be the avenue for increased regulation. I don't foresee that in the immediate future. These things happen slowly. And to the extent the asset class can maintain this sense of lower risk, lower loss, stability, that helps stave off some of that regulation. Because again, if I really had to boil it down, regulation comes when the consumers face loss. And so a couple of different moving parts there. We don't foresee anything in the immediate future, but it's a definite possibility.
Mm-hmm. Okay. Thank you very much.
Next slide, please. So across the economic and credit cycle, whether default rates are going up or down, growth is weak or strong, employment is rising or falling, there can be attractive opportunities in credit. It means I have a job across cycles, which is good. We see here the 4 phases of the economic cycle, which I'm sure you're all familiar with. What we've overlaid in the green boxes are some of the main private credit sub-strategies and when they typically see the greatest opportunity. So at different points in the cycle, these sub-strategies also align with different portfolio construction considerations, which you see in the bullet points. For example, in the current markets, which are indicated by that dark green circle, again, it makes sense to generally skew towards shorter duration, safer, contractual income-oriented credits. The point really being that an allocation to private credit can have both strategic and tactical roles to play in a broader portfolio, and partnering with best-in-class managers who can help make some of these timing and relative value decisions is a really good way to achieve exposure to the best opportunity across the cycle. Next slide.
I have a question
Oh,
before you leave
yes,
that
please.
slide. Can you go back to, yeah. So the cycles often last longer than the debt you hold and the sort of maturity of the debt you hold. And so some of these, for example, and I'm going to ask you a blunt question, why would you want to hold mezz debt through a cycle? Just asking. It always gets squeezed out.
Yeah, you wouldn't, is the short answer to that. And this really isn't sort of advocating a strategic allocation to mezz, but there can be opportunities to, in a sort of the mezz 2.0 world that we're in, to tactically pick up exposure to mezz. For example, right now what we're seeing is creditors not wanting to reprice the senior part of their stack. And so there's an opportunity to put in a quite attractively priced mezzanine piece. Whether that's attractive on a risk-adjusted basis depends on the credit, obviously. So mezzanine is a strategy in particular that I wouldn't advocate for strategic allocation across the cycle, but there are times when it can be opportunistic.
Right, but the terms have to just be screamingly attractive.
Yes.
Thank you.
Any other questions on that slide? Perfect. So here, oh, here we go. So we started the conversation, back to your point, Joseph, that the credit markets have grown dramatically. So assets under management and dry powder levels have grown, remain elevated, and notably fundraising activity continues to be quite strong. Really, in the frenetic markets of 2021, private credit fundraising reached new levels. You can see this in the chart at the bottom, which shows direct lending, distressed and special situations funds raised in North America over the last decade, peaking in 2021. I often get asked by investors, is there enough deal flow for all of this dry powder? And to be honest, there isn't a simple answer to that supply and demand balance question. But what I can tell you is that the growth of the loan markets has outpaced fundraising levels. So that suggests there's a lot of opportunity out there, but selection and structuring remain as critical as ever. So whether we call it a liquid credit, private credit, non-bank finance, the space has really evolved and grown in ways that we never could have foreseen 15 years ago. And today it's really an asset class that has an enduring role to play in the broader economic and financial markets. And so that's really the message that I would leave you with. There is an enduring role for private credit. It is complex. There are a lot of different ways to play it. So partnering with managers who can help you navigate that, time that, and achieve exposures to the best opportunities across the cycle is really quite a thoughtful way to approach the space. So hopefully the next time you enter a conversation on whether we've entered the golden era of private credit, which is a term that's getting thrown around a lot these days, whether here at a board meeting or at a dinner party, I hope there's something from this presentation that you found interesting or insightful that you can draw on. Thank you again for the opportunity.
Thank you for coming to visit us. We appreciate it. Are there any other questions for our esteemed colleague? Mr. Majorinian, any final comments?
No, none aside from thank you to Kristen and Allborn for a terrific, informative presentation.
I agree. Thank you very much. With that, we have a outstanding item on our agenda, which is approval of the minutes of the regular meeting of August 10th, 2022. I will move approval. Do I have a second? Second. Thank you, Mr. Green. Do we need a roll call?
Yep, I'll do.
Okay.
Mr. Kelly,
Yes.
Mr. Rue,
Yes.
and Mr. Green.
Yes.
Okay, the motion passes unanimously.
Thank you very much. Item 6, items for staff review.
No items,
Thank you very much. Item 7, items for future agendas.
no items.
Item 8, good of the order. Mr. Rue,
Good of the order,
good of the order.
good of the order.
This is reporting.
Anything you want to, yeah.
I'll pass to the general meeting.
Mr. Green? Mrs. Sanchez? Mr. Knox? I would just like to thank you again. It was a great meeting, very informative, and we'll see you next time. With that, I'll take a motion for adjournment. So moved, adjourned. Let's meet at 9 o'clock for the regular meeting. It's 8:40. We have a 20-minute breakfast break.